The problem is a lot of value stocks do have a lot of debt. And in the event that we are seeing a resetting of interest rates back to fair value, we've had, of course, below market interest rates now for nearly 10 years, that could be an offset. But interestingly, there is a milepost out there, and I think the Berkshire buyback could be the signal to say, you know what, these are, and most of these Berkshire companies are value-oriented companies. That's an indication that Warren thinks that that's the place to be.
Kate, let me ask you a similar question, but phrase it maybe a little bit differently. Given how much some of the big tech stocks are off, the FANGs, a couple of them in bear market territory, I believe Amazon has now fallen below 20% below its highs, Facebook 36% or thereabouts. At what point might some of those turn into value opportunities from where you sit?
Well, they certainly could, but they aren't there yet. We have hold ratings on both of those, and it really has to do with the outlook for their business going forward, the growth rates, and the fact that at higher interest rates, you have to discount the cash flows, and they're worth less than they were at lower interest rates. When we're looking for value, we're really looking at diversified companies that have solid dividends that are growing and have multiple lines of business and some pricing power. Now, in some cases, that's true of some of the FANG stocks. It's not true of all of them. And we'd be a little cautious on buying the things that are down the most, largely because they're not necessarily the best in the next phase of the market. As we get late into the cycle, what you want to look at are the companies that are really able to create their own future. And that's some of the technology stocks, but also some stocks in other sectors.
So let's turn to, Kate, just pick up there. You said that there were a couple of them that you liked that have diversified lines of business. Well, GE has that. Growing dividends, GE doesn't have that. So you're looking at other kinds of companies, maybe in industrials.
Yes, in industrials, we'd look at a company like United Technologies, which has the multiple lines of business, very well diversified. Its acquisition of Rockwell Collins, which is scheduled to close this quarter, should actually help it in terms of expanding its product line. It's got growing earnings, which has, of course, been a problem with GE. And it's had a track record, and we expect growing dividends in the future as well. We do think, in addition, that it's been hurt by worries about trade with China. And as a result, if you get any kind of resolution of that sometime in 2019, we're not optimistic for later this month, it's likely to be a catalyst for upside in those shares. So we're looking at companies that are very well positioned across different lines of business and have that growth potential as well.